Hello and welcome to another episode of Currency Derivatives Classroom. Today we will focus on the market dynamics of currency futures in India, comparing it with the global markets. I'm your host Gautam Srinivasan, and for this discussion today we have with us Mr. Srinivasan Varadarajan, who's the Executive Director of Corporate Banking at Axis Bank, and also joining us is Mr. Moses Harding, who's the Executive Vice President and Head of Global Markets Group at IndusInd Bank. Gentlemen, thank you very much for joining us. What are the key models we should be watching out for, and in terms of say volumes or regulations, how do they differentiate from each other?
I think if you look at the Indian context, it's not strictly comparable to most of the global markets. Clearly the Indian FX markets are a lot more regulated than most open global markets, where if you look at the OTC market here, regulations govern what exactly participants can do. And it is not a market in which allows free access to all types of investors. I think the exchange traded market in India clearly provides free access to all types of investors, provided they meet the margin requirements stipulated by the exchanges. So I think currency derivatives, I think, are a product globally which are very large. In India, the potential for its growth is extremely large because the participation in OTC markets to a large extent is still regulated, and therefore comparing volumes and participation in India versus global markets is not strictly comparable. It's not apples to apples. If you look
All right, but if you look at strictly for the benefit of our viewers, if you could just explain to us what are the various models prevalent globally.
I think all the models which are prevalent globally, both in OTC and exchange traded, are broadly the same, where you have access to transparent prices on screens, and margining, which is happening on exchanges right here, happens across both OTC as well as exchange traded markets globally. So I would think the models broadly which we have in place are state of the art.
So it applies anywhere, even if it's the United States or Britain or any other thing. Mr. Harding, would you like to add to that?
Actually, if you look at the functional process and operational guidelines, there is no difference between what is happening in India and abroad. In fact, I would say our exchanges are as efficient as the overseas markets. The main issue is the liquidity. There, the liquidity is much more than what we have today. I think our liquidity will be less than 1% what is happening in the overseas market because of the access. In India, we have a restriction in access. Only resident entities and individuals are permitted to access the futures market, whereas in the offshore market, anybody can access the market, and NRA can access the market. So the restrictive access only depends the liquidity in the volume. Otherwise, as far as operational guidelines, rules of the game, everything is one and the same, and we are as efficient as global markets.
Right, but we are still at a nascent stage, as you said. We are still starting. Or if you look at, say, Brazil, where currency futures have been going on, trading in currency futures has been going on for about 17 years. Now, looking at the global markets, while you say that there is not much of a difference, is there any key takeaway we can take from some particular markets, key lessons which we can apply back in the Indian markets for raising volumes, raising access, and also to minimize but not completely do away with the regulatory mechanism?
I think the model is broadly there. I think it's a question of how do you encourage more participation, which is what is going to, which is keep improving volumes. And I think if you look at the percentage of trading volumes on exchange traded currency derivatives versus OTC derivatives, I think the percentage of volume is actually quite large. If you look at, if OTC market was the only thing which existed till date, and if you look at volumes on exchange traded futures versus OTC market, it's already very high. So the acceptance of the product is there. It's a question of how much you can educate the investor, get more investors, clients, corporates, whoever they are, in terms of into this market. That's when it's going to grow in volumes. As Moses was saying, if you're able to get foreign participation in, again, volumes will skyrocket. So it's a question of more participation in various types of investor segments. That is key to driving volumes, not anything to do with the model as such.
So what's your prescription for that? If you want to drive up volumes and drive up access, what would be your prescription to the
authority? I think the short prescription is encouraging more foreign participation. I think it is clearly, that is something which can help. But even otherwise, I think the access, the product is very new. I think it is gaining popularity across length and breadth of the country, like you have in equities. I think currency risk is something which everyone faces across the country, however small a corporate may be. And that is something which, as people get more and more aware of the risk and try and manage that, the exchange traded market is a lot more transparent and easier market to access, and that is where you will see the volume growth in volumes.
But Mr. Harding, has the growth in exchange-traded currency futures in India been satisfactory according to you? How do you see the segment shaping up?
See, I'll take this question from two different segments. One is resident individuals and resident corporates who have access to the market. For resident Indians, it's one more asset class for them to invest. They trade in equities, they trade in bonds, and currency is one more asset class. And investors, they like anything that moves so that they can make money on the price appreciation or depreciation. But this is a product where it's meant for investor categories who have a high risk, high reward appetite. Because the market is volatile and markets have different dynamics. So I think any investor allocating 10 to 20% of funds for this currency market will be a good one, because although the risk is high, the reward is also high. You see a volatility of 0.5 to 1% intraday. So if you aggregate it on an annualized basis, it's a high risk product and a high rewarding product if handled well. But on the other side, corporates entering the futures market when there is an arbitrage for them, if the price is better than what is available in OTC. And for the investor class, I think this is a good product for an investor who has a high risk, high reward.
All right. So what about the roadblocks, Mr. Varadarajan? Any possible roadblocks like, say, rupee convertibility or any other issues which you think need to be addressed in order to drive up more investment flows?
Capital account convertibility is not something we can say as a precondition for growth, because that's not in our control.
Viable demand.
Yeah, that's not in our control, and it's going to.
But in terms of other roadblocks, what do you?
The other roadblocks, as I said, I think. Domestic investors, all types of investors, there is no restriction in terms of participation. It is only the foreign investor interest which is clearly there is a policy which clearly can be changed to allow more foreign investor participation.
Mr. Harding, would you like to add to that?
So actually, as far as policy guidelines are concerned, I think the present policy guidelines are very sufficient. You and I can take an open position up to $10 million. I don't think you need more than that. And a broker can have a $50 million and bankers $100 million. So I don't think policy restriction is on the way. I think the education, customer education by the exchanges,
that is more paramount
to promote this as an alternate asset class for investment of the funds. I think that's lacking.
All right. Well, we'll take a short break on that note, but in the next segment, we will be taking queries from our viewers and more answers from our experts. Stay tuned.
Banks can still be more active participants in currency futures because they are the only intermediaries who have unlimited access across OTC and exchange traded and can straddle both markets and arbitrage both markets.